Hi, folks. Best-selling author and certified tax specialist, Navy Dowty here. You know, with the economic downturn in the news every day, along with rising interest rates, rising inflation, and soon rising taxes, I thought I'd give an update to you on my crystal ball. Remember my crystal ball? I gave a talk a few years ago to a group of business people up in Boston, and I wanted to have a visual for them, and I made this crystal ball. So let's take a quick look at this because it's even more pertinent now than it was then. If you look at the first half of this, between 1965 and 1982, you had massively rising interest rates. And 1965 is kind of an important year. If you think about what happened, Federal Reserve was invented back in 1913. Lots of books written about it, good and bad, and I don't want to get into that, but I can tell you that the mandate of the Federal Reserve in the first part of that cycle between 1913 and 1965 was to protect the value of the dollar. That all changed in 1965. We were just starting in the Vietnam War, and they didn't want to raise taxes, but they needed more money. And so the mandate changed, and it changed to let's manage the economy. So since then, controlling interest rates and printing more money is the way that the Federal Reserve has tried to control the economy. What the mechanism is important, the motives aren't necessarily that important, but what happened was interest rates went way up. Actually hit a 100-year high back in 1982. Why is that important? Well, back in 1982, I was one of the first certified financial planners around back then. And the marketing people came around. And I remember this one guy came in, he said, whatever you do in your marketing, never, ever use the words the market or use the words in mutual funds, because people have been losing money in their mutual funds so long, they hated mutual funds. Paper assets, stocks and bonds, which were what people were invested in their mutual funds, had been going down ever since 1965. It got so bad that you could actually buy stocks in 1982, in the fall of 82, for less than the cash they had in the bank. So if a company had $100 million in the bank, you could buy the whole company for $75 million or so. And you got the company free. You just got to buy the cash for 75 cents on the dollar. It was really crazy, but people just didn't like stocks. They were throwing stocks away. Then we had this long 40-year slide in interest rates. Went down from a 100-year high in 1982, got down a couple of years ago to the lowest rate in human history, in recorded history. Now think of that. It wasn't just in the United States. This was a coordinated effort all over the world, because the central banks found that they could, make the economy better by lowering interest rates. Well, how does that actually happen? How do interest rates actually get controlled? Right now, another thing that's in the news is the idea of this inverted yield curve. All that means is the short-term interest rates are higher than the long-term interest rates. What creates those interest rates? Well, the long-term interest rates are created by the bond buyers. If the U.S. government issues a bond, let's say a 30-year bond, $1,000 increments is how they sell bonds, and they're going to pay $40 a year for that bond. $40 divided by 1,000, that's 4%. If nobody will buy that bond for 1,000, they say, I'm not going to pay 1,000, I'll pay 900. Well, now you take $40 divided by 900, it's about 4.4%. Right? It's a little higher. That's a little more complicated than that, because the bond will pay off 1,000 30 years from now. So you go from You'll get that $40 a year, but then you'll also get that extra $100 at the end when it pays off. So it's slightly more than 4.4%. So that's what actually creates the long-term interest rates, is the bond buyers. What creates the short-term interest rates? Short-term interest rates are created by the Federal Reserve. They just declare a rate. And both the long-term rates and the short-term rates are higher now. It's just that the Federal Reserve has raised the short-term rates to be higher than the long-term rates. That's all that's happened. So what does this mean? So far in history, most of the time when short-term rates are higher than the long-term rates, it's been very, very bad for the economy. It has presaged a big economic downturn, and that appears to be happening. A little while after I made my crystal ball, I was sitting in a conference in New Zealand, and I looked out the back window and I could see the waves crashing up on the beach. And I thought, there's going to be some big coming financial tidal waves. And I call this my ultimate financial tsunami. You can see this: rising interest rates, rising taxes, and rising inflation. Well, as I said, it's in the news now every day. Back then, I was hoping that would not actually happen, but it is happening, presaging big economic downturns. So along with rising interest rates is rising inflation. So what's the solution to all this? A couple of things. One of them relates to taxes. Taxes are going up on January 1st, 2026. You click the link below, just contact our office. I'll get you a copy of my Smiling Retiree Save Taxes checklist. 199 ways to save taxes. There's a bunch on the front, and I put it in fine print on the back. I put in as many as I could. There are actually a lot more than that, but that'll get you started. 199 ways. If you're watching this, you're almost certainly paying more taxes than you have to. But really, the answer is my On-Tax Family Wealth Smiling Retiree process. It's a process. It's not a product. 3 major categories: the foundation, the obstacles, and then the solutions. Everybody has to go through this process if they want to get into a decent retirement. We're going to go from point A, fear, confusion, and worry, to point B, peace, freedom, and impact. So whether you need less taxes, everybody wants to pay less taxes. We all have to pay our fair share. So when we talked about taxes, we're really only talking about things that are legal and ethical. No wild theories about why you shouldn't have to pay your taxes. Everybody has to pay our taxes. We live in the greatest country in the history of the world. We all have to pay our taxes. We just don't have to pay excess taxes. Almost everybody's paying more taxes than they have to. Click the link below. I'll get you a copy of my Save Taxes checklist and a copy of my On-Tax Family Wealth Smiling Retiree process. I'm Navi Dowty, and remember, financial fitness can be beneficial to your wealth.